Hi everyone, I'm excited to welcome you back to our MCQ Marathon playlist. Now, it has been a while, and actually, this has been a request. It has taken quite a long time in the making, and so I'm so happy to share with you that for this round, we're going to answer not just 100, but a total of 150 multiple choice questions designed in a 25 item MCQ interval to, of course, make sure that we crack the audit code with questions for board exam preparation. Friends, this is round four, part one. Let's answer question number one. Which of the following statements is true? If the control risk is assessed at the maximum, and once we read that question, then we get to think about if the control risk is assessed at maximum, that simply means that the auditor does not intend to rely on the controls. Based on the preliminary control risk assessment, which is based on its design and implementation, it would seem that the controls are not reliable. And when the controls are not reliable, then the auditor assesses the acceptable level or sets the acceptable level of detection risk at a low level. Remember, because when we set the acceptable level of detection risk at a low level, that means we are being very strict. And being very strict means we will modify nature, timing, and extent. In terms of the nature of the testing, we'll choose the more effective procedures. In terms of the timing, we'll test as close to the balance sheet date as possible. And in terms of the extent, we will, of course, choose the larger sample size. And so in this case, the correct answer should be letter C. Change the nature of the related substantive test to more effective procedures. Take note again that maximum control risk assessment means we will be strict. By being strict, we will set acceptable level of detection risk at a low level, and so therefore would choose more effective procedures. Let's go on to question number two. Confirmation is most likely to be a relevant form of evidence with regard to assertions about accounts receivable when the auditor has concern about the receivables. And we know confirmation is a very common audit procedure for accounts receivable, and this mainly addresses the assertion of existence. We are also reminding everyone that confirmation is done as an example or as a procedure for substantive test of balances. Let's move on to question number three. An auditor will most likely estimate the tolerable failure rate, which is just another fancy term for tolerable deviation rate or tolerable exception rate or maybe even tolerable misstatement. But since we're talking about the rate, so this most likely refers to tolerable deviation rate or tolerable exception rate. So why do we set the tolerable failure rate? Is it letter A to calculate the probable control risk, or letter B to determine the population to be tested, letter C determine the appropriate sample size, or letter D determine which type of sampling approach to use? Now we are reminded in the case of letter D and letter B, so Bravo and Delta, determining the population to be tested and determining which type of sampling approach to use, this is mainly a matter of the auditor's professional judgment. The calculation of the probable control risk, actually control risk is evaluated or assessed by the auditor using risk assessment procedures. And so therefore, we will use tolerable failure rate in order to determine the appropriate sample size. And here we are reminded that tolerable failure rate or tolerable deviation rate bears an inverse relationship to our sample size. So that's Charlie for number three. Moving on to number four, which of the following statements regarding statistical sampling is in auditing is true? So let's go over each statement and decide whether they are true or false. Starting with letter A, sampling methods are used by auditors in both testing of controls and substantive testing. And at the onset, letter A sounds like a true statement, right? An auditor may use sampling methods, whether it's TOC or substantive testing. Letter B, statistical sampling methods are more appropriate for testing of controls when the auditor elects to reprocess transactions than when controls are tested by means of document examination. And letter B is not true. As to whether it's reprocessing or document examination, statistical sampling may still be used by the auditor. Letter C, although statistical sampling may be applied to test of controls, it is required for substantive testing purposes, and that is not true. The use of both statistical and non-statistical are acceptable. Not one is favored over the other. So letter C is not true. Letter D, inasmuch as audits are test-based, generally accepted auditing standards require the use of statistical sampling methods whenever you decide to examine only part of the population. And what we have mentioned, this is definitely not true. Both statistical and non-statistical are acceptable. That means the first statement is true. The answer to number four is alpha. Let's go on to number five. Which of the following controls most likely could prevent EDP personnel from modifying programs to bypass program controls? Letter A would say participation of user department personnel in designing and approving new systems. But do take note, the main issue here is to prevent EDP personnel from unauthorized modification of the program. So if you would reflect on it, letter A will not address the concern. Letter B, segregation of duties within the EDP for computer programming and computer operations may very well be the answer to this, as the segregation of duties would definitely prevent unauthorized modifications. But nonetheless, let's still read letter C. Letter C is periodic management review of computer utilization reports. This at best might be more detective rather than preventive, and so would not be able to address our main issue. Similar is with letter D, physical security of EDP equipment. What is secured, what is safeguarded in letter D is the physical equipment. Our main concern here are the programs. And so therefore, the correct answer is letter B. Let's move on to number six. In auditing accounts payable, an auditor's procedures most likely will focus primarily on the management's assertion of, and to this, that as remember that when we talk about assets and revenues, our main or primary focus will be the assertions of existence. In terms of liabilities and expenses, the auditor's primary focus is actually on the assertion of completeness. And so the answer to this is letter C. Number seven, which of the following procedures would an auditor most likely perform in planning a financial statement audit? We are talking about the planning phase of the audit. Letter A says searching for unauthorized transactions that may aid in detecting unrecorded liabilities is done in the testing phase and not in the planning phase. Letter B, examining computer generated exception reports to verify the effectiveness of internal controls is also done in the testing phase. Letter C, inquiring of the client's legal counsel concerning pending litigation is related to the auditor's responsibilities for litigation's claims and assessments and is done by the completion phase. And so that leaves us with letter D, comparing the financial statements to anticipated results as the answer to this one. Performing this during planning will help the auditor set the right expectations, especially in the performance and investigation later, and when the auditor performs analytical procedures to determine if there are any unusual or unexplained relationships across the account. So that's delta for number seven. Let's move on to number eight. Which of the following accounts would most likely be reviewed by the auditor to gain reasonable assurance that additions to the equipment account are not understated? So do take note, the main issue here is that there may be additions to the equipment account that were not recorded as an equipment. And in this case, the account that we would most likely review is repairs and maintenance. So we get to acknowledge, of course, that repairs and maintenance expenses are on the debit side, similar with our assets, and it is highly likely that items which are supposed to be capitalized or which have met the capitalization threshold may have been inadvertently recorded as an expense instead. So that's why the answer here is letter C, repairs and maintenance expense. And when we review the ledger for this accounts, we will be on the lookout for assets which have been recorded as expenses, thereby rendering the asset account understated. So Charlie for number eight. Number nine, which of the following statements is not true? So we're looking for the incorrect statement. Letter A says the persuasiveness of evidence can be evaluated after considering its competence and its sufficiency. And letter A is a true statement. Letter B, a small sample of only one or two pieces of relevant, competent, and timely evidence lacks persuasiveness. And letter B actually is not true. While we take a look at what is being highlighted here as a small sample, but if you look at the characteristics of the sample, it's relevant, competent, and timely. So think, for example, of the reliability of audit evidence, whereby we say, as an example, evidence which the auditor was able to obtain directly is more reliable than those from inference. And so in that case, you may not necessarily need a lot of evidence because the evidence is already highly reliable. So letter B is actually not true. But let's evaluate the other statement still. Letter C, a large sample of highly competent evidence is not persuasive unless it is relevant to the objective being tested. And that is true. We always remember that when we gauge the appropriateness of the evidence, we have to look at what objective are we trying to test. And so whether the evidence is relevant or not will depend on the objective that we are testing. And this is one of the perfect examples when we say, if you wish to test for completeness and you are performing vouching, then that simply wouldn't do, right? As completeness will be appropriately tested using tracing. And so letter C is a true statement. Letter D, a large sample of evidence that is neither competent nor timely is not persuasive. Definitely true. So that means letter B is indeed the incorrect statement. So bravo for number 9. Number 10, accepting an engagement to examine an entity's financial projection. And before we go any further, we are reminded of the prospective financial statements, right? We basically have two frameworks for that: financial projections and financial forecasts. So in this case, when we talk about forecasts, we are reminded that this uses management's expected actions. When we talk about projections, this uses hypothetical what if scenarios. And to this, we are reminded because forecasts use expected actions, forecasts may be made available to either to either the public, okay, or to specifically determined recipients of the report. So it may be of general public or limited specifically identified recipients use. So that's for the forecast. But in the case of projections, because projections make use of hypothetical assumptions, what if assumptions, projections are only allowed for limited use. Okay? And so we go back to the question. In the case of financial projections, most likely would be appropriate if the projection were to be distributed to, and remember, we're looking for the one that represents limited use. Letter A says all employees who work for the entity, definitely general. Letter B, all stockholders of records as of the report date, definitely general. Letter C, a bank in which the entity is negotiating for a loan. So let's put that to the side. Or letter D, potential stockholders to request a prospectus or a registration statement. Let's also put that to the side. And now we have two remaining choices, Charlie and Delta. Choose the one that most perfectly represents limited use. And of course, for that, the answer should be letter C, right? Because you're able to specifically identify which particular bank and which particular officer of the bank would be utilizing the information. So letter C for number 10, being, of course, that we're talking about projections, and projections make use of hypothetical assumptions and should only be for limited use. So Charlie for number 10. Number 11, which of the following statements occurring after the issuance of an auditor's report most likely would cause the auditor to make further inquiries about the previously issued financial statements? And this one requires us to touch base a little bit on our responsibilities for subsequent events, particularly the two types of subsequent events. Of course, the type 1 and type 1 requiring adjustment, and type 2 requiring disclosure. So letter A technological development that could affect the entity's future ability to continue as a going concern is letter A. Letter B, the discovery of information regarding a contingency that existed before the financial statements were issued. Letter C, the entity's sale of a subsidiary that accounts for 30% of the entity's consolidated sales. Or letter D, the final resolution of a lawsuit which is adequately explained in a separate paragraph of the auditor's report. So which of the four would most likely prompt you to make further inquiries about the previously issued financial statements? When we evaluate these choices, we could already remove letter A, and we will also be removing letter C, as both A and C represent future impacts. So if you're talking about the financial statements that is audited, say for example, for the year ended December 31, 2024, we give our opinion on the financial statements as of and for the years ended December 31, 2024. That means looking at A and C, these would all affect the future performance of the entity, and so is not necessarily captured within our opinion for 2024. This therefore leaves us with two other situations: Bravo, which talks about the discovery of information regarding a contingency that existed before the FS were issued, and Delta, there is a final resolution of a lawsuit, but this lawsuit has already been adequately explained in the auditor's report. So between Bravo and Delta, the one that will prompt up to make further inquiries would definitely be letter B, as unlike letter D, letter B has not yet been considered by the auditor. So Bravo for number 11. Number 12, an auditor has calculated the interest paid on a company's recorded bonds and found the interest was 10%. However, in examining the bonds, the auditor notes that they are actually 8% bonds which were sold without a premium or a discount. Which of the following is most likely? Letter A, overstated common stock, but we are talking about bonds here. Letter B, understated debt outstanding. Letter C, overstated accrued interest receivable. Or letter D, understated interest expense. And to this, I think we could already rule out it's not alpha, neither is it Charlie, because we're talking about bonds payable. So it can't be about equity nor about assets, right? So we're left with two, understated debt outstanding or understated interest expense. And the correct answer to this one is Bravo, understated debt outstanding. So let's try to illustrate. Say, for example, the face of the bonds was 10,000, and remember, the auditor found that the interest paid was 10%. So that would lead to very simple illustration, interest expense of 1,000. However, when the auditor examined the bonds, the auditor found out that the actual rate or the rate indicated in the bond indenture was only 8%. So if 1,000 is good for 8%, okay, then that must mean that the face of the bonds should have been 12,500. This would represent understated debt outstanding, whereby the client recognized only 10,000 in debt when in fact, based on the interest computation and on the coupon rate found in the bonds, it should have been 12,500. So that's why the answer to this is Bravo. Number 13, which is not true of the intended user. And this takes us back to the five elements of the assurance engagement, where we have the three-party relationship amongst the intended user, the responsible party, and the practitioner. Okay, and this one talks about that very first element. Of course, we do have the element of the appropriate subject matter, relevant criteria, suitable criteria rather, sufficient and appropriate evidence, and a written assurance report. So let's go back to the three-party relationship, and we're going to look for the statement that is not true regarding the intended user. Letter A, the intended user or users may not be the addressee of the professional accountant's report. Letter B, the responsible party may also be one of the intended users. Letter C, the intended users are always limited to the addressee of the professional accountant's report. Or letter D, the intended user is the person or class of persons for whom the professional accountant prepares the report for a specific use or purpose. Of the four statements, we could say letter B is definitely true. We know that the responsible party may also be one of the intended users, and letter D is also true. That is the definition of intended users in case of specific user purpose. That leaves us with Alpha and Charlie. In Alpha, it says the intended user may not be the addressee, and in Charlie, it says the intended user is always limited to the addressee. In this case, the statement which is true is actually letter A. The intended user does not necessarily have to be the addressee. That makes letter C as the incorrect statement. The intended user is not always limited to the addressee. Say, for example, if we talk about the intended user being the foreseen and foreseeable third parties, we talk about prospective stockholders, we talk about creditors, for example, they are not necessarily named as addressees to the professional accountant's report, but that doesn't mean that they are not users of the report. So it is not true that it is always limited to the addressee. In fact, these intended users may not even be named as the addressee. So the answer to number 13 is Charlie. Number 14, only one of the following four statements which compare confirmation of accounts payable with suppliers and confirmation of accounts receivable with customers is true. We are going to look for the true statement. Letter A, statistical sampling techniques are more widely accepted in the confirmation of accounts payable than in the confirmation of accounts receivable. And that is not true. As what we have previously mentioned, both statistical and non-statistical are widely used and are acceptable. So letter A is not true. Letter B, it is less likely that the confirmation request sent to the supplier will show the amount owed him or her, then the request sent to the customer will show the amount due from him or her. So let's break this choice down. It says it is less likely that the confirmation sent to the supplier, meaning to say this is the case of an accounts payable confirmation, will show the amount. So it's less likely that the AP confirmation will contain the amount. It is more likely that the AR confirmation will contain the amount. And if you think about it, when you do not include the amount, in this case, as in an AP confirmation, by removing the amount, you are actually changing the nature of the confirmation. Well, not so much really as changing the nature, but allowing the supplier to indicate the amount. And this will help you address the assertion of completeness. Whereas if the amount is already present, just like in accounts receivable, this addresses more the assertion of existence. And if you remembered, we did say in the case of liabilities and expenses, we are more concerned with completeness, assets and revenues, we are more concerned with existence. So letter B has a high chance of being the true statement. Letter C, confirmation of accounts payable with suppliers is more widely accepted than is confirmation of AR with customers. And actually, letter C is not true. In fact, AR confirmation is more common than AP confirmation, as there are other documents we could readily check, other external documents we could readily check for AP confirmation. Letter D, compared to confirmation of accounts payable, the confirmation of AR will tend to emphasize accounts with zero balances. Now, the emphasis of accounts with zero balances is intended to test the assertion of completeness. If we're talking about AR, we are more concerned with existence. That is why the answer to this is bravo. By removing the amounts on the confirmation request sent to the supplier, aka AP confirmation, this addresses the assertion of completeness. So bravo it is for letter B. Number 15, an auditor selected items for test counts while observing a client's physical inventory. The auditor then traced the test counts to the client's inventory listing. So, can you picture out what the auditor is doing here? You selected items for test counts and then you trace the test counts to the client's inventory listing. Definitely, this is in order to test management's assertion of completeness if what the auditor has actually counted was reflected in the records. So this is intended to answer the question, are the records complete? So letter D for number 15. Number 16, an abnormal fluctuation in gross profit that might suggest the need for extended audit procedures for sales and inventories would most likely be identified in the planning phase of the audit by the use of, and in this case, we're talking about abnormal trends, abnormal fluctuations, similar with abnormal relationships when we make use of trend analysis, horizontal, vertical analysis, ratio analysis. This is conducted by, or this can be seen when we make use of analytical procedures. So that's Charlie for number 16. And a quick pit stop, when we talk about analytical procedures, they may be performed in the planning, testing, and completion phase of the audit, and they are required in both planning and completion. They are only optional for the testing phase. So that's Charlie for number 16. Number 17, which of the following statements concerning analytical procedures is true? So, letter A, analytics alone may provide the appropriate level of assurance for some assertions. Letter B, analytical procedures used in the planning phase should not use non financial information. Letter C, analytical procedures usually are effective and efficient for tests of controls. Or letter D, analytical procedures may be omitted entirely for some financial statement audits. So let's evaluate the statements. We can say we can already remove delta because we know it's required for planning and completion. You can't eliminate it entirely. We could also already eliminate Charlie because we cannot use analytical procedures for test of controls. So if you would remember our listing of the procedures for TOC, we can only perform the big three: IIO, inquire, inspect, observe, and to that we will add reperformance. Analytical procedures is not part of our test of controls. We could also already remove letter B because we should use non-financial information when we come come up with our expectations, especially, okay, for analytics. That means letter A is a true statement. Analytical procedures alone may provide appropriate level of assurance for some assertions. If you think, for example, about testing interest income or interest expense, or testing depreciation, for example, these are readily predictable accounts where analytics are seen to be very effective. And so that alone, analytics alone, may already give you the appropriate level of assurance for those. Okay, so alpha for number 17, looking at reasonableness of the accounts. Number 18, an auditor is testing credit authorization procedures by examining sales invoices for credit approval by the credit department. The procedures will be considered to be working adequately if 96% of all sales invoices either indicate approval or are cash sales. So from this, we could already infer that the auditor has set a tolerable exception rate of 4%, right? Now, the auditor selects a random sample of 100 invoices. In this situation, which of the following outcomes illustrates underassessment? Okay, so before we go to the choices, two things. Number one, tolerable exception rate is 4%. Number two, we're talking about underassessment. When you say underassessment, that means you have assessed control risk to be too low. So when you have assessed control risk to be too low, that means that you have decided to rely on the controls when in fact they are not reliable. So let's go back and break it down. Under assessment, meaning you assess control risk too low. By assessing control risk too low, that means you relied on the unreliable. So we are going to look for the choice that will illustrate relying on the unreliable. Letter A says, you have found no deviation and conclude that procedures are working adequately. The true population deviation rate is 5%, meaning to say, based on the results of the sample, you are saying that, well, the controls are effective. And the true population deviation rate was actually 5%, and you were only willing to tolerate 4%. Okay, so that's letter A. Letter B, you found no deviations. You conclude that the procedures work adequately. So you relied. The true population deviation rate is 2%. You were willing to tolerate as much as 4%. Letter C and D says that your procedures, meaning your sample size, allowed you to conclude that the controls were inadequate. In this case, we can already remove C and D. Why? Because the scenario that we're looking for is under assessment, meaning we're looking for the scenario where we relied. Letter C and D already says we did not rely. So you can remove C, you can remove D. That leaves us with either alpha or bravo. So which one would represent under assessment? Under assessment means actually over reliance, right? You assess control is too low, you relied on it when it's not. So under assessment is another way of saying you over relied. So compare letter A, it says the true population deviation rate is 5%. You were only willing to tolerate 4, meaning in the case of letter A, your tolerable deviation rate has already been breached, right? In comparison, in letter B, the tolerable population deviation, I mean, the true population deviation rate was only 2%. You were willing to tolerate all the way up to 4, meaning your tolerable deviation rate was not breached at all. So the illustration of underassessment is letter A, right? Because in this case, it was not actually reliable. It has breached your tolerable deviation rate. And yet, because of your sample, you thought it was reliable. So that's alpha for number 18. Number 19, with respect to the auditor's planning of a year-end examination, which of the following statements is always true? Always true. Letter A, it is acceptable to practice, sorry, it's an acceptable practice to carry out substantial parts of the examination at interim dates. Letter B, the client's audit committee should not be told of the specific audit procedures that will be performed. Letter C, an inventory count must be observed at the balance sheet date. Or letter D, an engagement proposed after the fiscal year ends should not be accepted. Remember, we're looking for the statement that is always true. We now evaluate our choices, and in the case of letter D, an engagement proposed after the fiscal year ends should not be accepted is not true. In fact, it is quite common for auditors to be appointed after year end. We can also remove letter C already, right? An inventory count must be observed at the balance sheet date. Actually, an inventory count can be performed a few days before, a few days after. The important thing is it is as close to the balance sheet date as possible, but not necessarily on the exact balance sheet date. Okay, so can you imagine having to report for an inventory count observation on midnight of December 31? So that is not always true. It would be good practice, no, but it's not practicable, so therefore it's not always true. The client's audit committee should not be told specific audit procedures. Also, not always true. There are exceptions to this. For example, in the case of the use of experts, the audit committee must be informed. The audit committee is also informed of the generic or general, not specific, okay, the broad strokes of our planning considerations. So letter B is not always true. That means the statement that is always true is letter A. It's acceptable for you to carry out substantial parts of the examination at interim date. So alpha for number 19. Number 20, which of the following statements is true with respect to management representations? And this allows us to review a little bit the concept of written management representations, where we say there are actually two types. There's the general representation and then there's a specific representation. So we talk about general representation. This refers to the premise of the audit, meaning to say the responsibilities of management, and specific representations would refer to specific accounts, transactions, balances, and events. So we're looking for the true statement. Letter A. Management representations are signed by the auditor and delivered to the client's officers is not true. Management representation letters are signed by the client and addressed to the auditor. Letter B. Management representations are used to corroborate information obtained during the audit. And this is true, right? We do say management's representations are part of audit evidence. However, they should not be taken at face value. Rather, they are seen as more of a corroboration, or they yes, a corroboration of what management has been representing to the auditor. More often than not, also we would need to gather additional audit evidence in order to also corroborate the representation letter of management. Letter C, management representations are dated as of the balance sheet date. This is not true. It should be dated the same date as the auditor's report date. Letter D, management representations may serve as a substitute to various types of substantive procedures. Not true. Again, we mainly use it as corroboration, or should we have no other information but management representations, we are required to still corroborate or perform procedures to help us determine if the representations are reliable or not. So letter D is not true. It cannot be a substitute to our audit procedures. So the correct answer, the true statement, is bravo. 21. If an auditor conducts an audit of financial statements with generally accepted auditing standards, which of the following will the auditor most likely detect? Letter A, misposting of recorded transactions. Letter B, unrecorded transactions. Letter C, collusive fraud. That should not be fun, but fraud, collusive fraud, or letter D, forgery. Likely to be detected by the auditor is the misposting of recorded transactions, as this reflects an error, illustrates an error rather than a fraud. While unrecorded transactions may be an error if it was not done, intentionally, but as we have also pointed out in our previous discussions, it's the error or the fraud of non-recording that is actually very difficult to uncover. More so when we talk about forgery, as this is beyond the scope of our expertise, and of collusive fraud, as this will now involve more than one department or one person. So letter A is the answer for 21. 22. The auditor is performing substantive tests several months before the end of the year. That means the auditor is performing an interim testing, right? So when does the auditor perform interim testing? Let us go back to our previous discussion. When we talk about the risk of material misstatement, if the risk of material misstatement is high, that means the auditor will set acceptable detection risk at low. By setting acceptable detection risk at low, that means we are being very strict. And by being very strict, we will choose procedures that are more effective. We will test as close to the balance sheet date as possible, and we will use a larger sample size. On the other hand, when we talk about, or in the opposite side of the coin, right? If the risk of material misstatement is low, that means we could set acceptable detection risk as high, we're chill, we're relaxed. And when we are relaxed, we will perform interim testing. We will we may use less effective procedures, and we will use a smaller sample size. So we are now going to look for the choice that represents a relaxed auditor, meaning to say low risk of material misstatement. So if inherent risk is set at moderate to high, that's high RMM or risk of material misstatement. Control risk is set at a maximum, that's high RMM. Detection risk is set at moderate to high. So if your acceptable level of detection risk is moderate to high, that means your RMM is actually low. That makes letter C the answer to number 22. Let take note, if you answer letter D, detection risk is set at very low, that means you're being very strict, and you are being very strict because RMM is high. So Charlie for 22. 23. Which of the following transactions would an auditor most likely propose an adjustment to the financial statements? Okay, so letter A, an order for office supplies that has not been recorded because the goods have neither been received nor paid for by the year end. So take note that what happened by the year end was simply an order for office supplies. Okay, the actual purchase has not yet been consummated, the goods have not yet been received. So you would most likely not find any need to propose an adjustment for letter A. Letter B, purchase of 5,000 pesos of office furniture that was ordered on December 22 with a 1,000 deposit being made with an entry debiting deposit on furniture and a credit to cash for 1,000. The office furniture was received on January 5. So considering that the office furniture has not yet been received on December 31, then it is, we might say, appropriate, okay, for the client to have simply lodged it under a deposit on furniture account. Okay, so perhaps that account exists in their chart of accounts. So there is no need to propose an adjustment for letter B. Letter C, shop supplies are included in the balance sheet at year end, but the payable and the subsequent cash disbursements are not recorded until after year end. So if you think about it, the shop supplies, meaning the assets, were included on balance sheet date, but the payable was recorded until after year end. And this might lead you to ask the question, so then what was the credit when they recognized the shop supplies, right? So letter C most likely would represent an instance where we might need to propose an adjusting entry. Okay, because the pairing doesn't make sense. The assets were recognized as of year end, but then the liabilities and the subsequent payment were recognized in the subsequent period. Letter D, inventory is included in the balance sheet at year end, but the check for payment has not been paid until January 12, and this is a perfectly normal transaction, right? Because we are using the accrual basis of accounting. So that means the one that will require an adjustment is letter C. 24. Although most substantive testing is performed during the final audit, some substantive tests may be done during the interim period. Which of the following statements concerning the timing of substantive tests is true? Letter A, when internal control is weak, extensive substantive testing should be performed during the interim audit, and this is not true. If the internal control is weak, that means the auditor must be strict, and when the auditor is strict, the auditor will endeavor to test as close to the balance sheet date as possible. So letter A is not true. Letter B, if internal control is weak, the auditor should confirm accounts receivable as of a point in time at least 1 month prior to the client's fiscal year. And again, if the risk of material misstatement is high, that means the auditor should endeavor to test as close to the balance sheet date as possible. So not letter B as well. Letter C, substantive testing should be performed during the interim audit only under conditions of excellent internal control. However, to this, we are reminded that we are talking about our risk assessment, and the risk assessment does not only cover internal controls, but also inherent risk, right? So letter C is also not true. Letter D, as a general rule, you perform substantive tests of balances as of the balance sheet date and tests of transactions during the interim as well as in the year-end audit. Letter D then is the correct statement in the case of question number 24. And now we go to question number 25. Which of the following control procedures would most likely assure that access to shipping, billing, inventory control, and accounting records is restricted to personnel authorized by management? So we are talking about restricting access. Letter A, establish policy, procedure, and procedures manuals, organizational charts, and supporting documentation. Letter B, segregate the responsibilities for authorization, execution, recording, and pre-number and control of the custody of documents. Letter C, establish the cash receipts function in a centralized location which require daily reconciliation of cash, receipt records, and deposit slips. Or letter D, periodically substantiate and evaluate the recorded account balances. Take note, we are concerned about restricted access to shipping, billing, inventory, and accounting records. So in this case, the best control activity will of course be segregation of duties. So that's bravo for number 25. And like I have previously mentioned, this is actually a 150 item set. We're going to take a momentary stop here, so just to make sure that this is not overwhelming. And when you are ready, I hope to see you in round 4, part 2, that will be in our next video.